Hello, this is Mike Swanson. I run the website WallStreetWindow.com. And today I got a very special guest that I'm speaking with. I'm speaking with David Skarica, who runs the website Profit from Pessimism.com and the YouTube channel. And he's also been a close friend of mine for over 20 years. And he
Yeah.
just came out with this brand new book, Mega Returns. Profit from Maximum Pessimism. It's available from Amazon.com, and it's like a 200-page book, so it doesn't take a long time to read it, but it's packed with information and a great overview of what Dave sees as ways to make money in these markets, and not just short term, but the long term underlying trends impacting everything. So, congratulations on the book, Dave.
Yeah, thank you. It was actually published back in the spring. And actually, what the great thing about it is that, I do talk a lot about gold and precious metals in the book. And of course, it actually, since essentially it was about the low of this year in the spring when the book was published. And, obviously in the last 6 months, outside of this little correction we've had recently, the gold stocks and precious metals and gold and silver themselves have done phenomenally well.
Right. Well, looking at the book, just to give people, I'm not recommending people buy it and read it, but I just want to give a couple of the high point topics in here. And the first one, the introduction in the first chapter is all about the debt markets, the end of the debt super cycle, and
Yeah.
what you see could be the next big short.
Yeah, so like what the debt super cycle is or whatever, or also it's kind of like I talk about like the everything bubble and the bubble and financial assets, but definitely with the debt super cycle, it's like I think we're nearing an end game because the debt to GDP is now getting close to 130%. The deficit is over $2 trillion. It's showing no signs of slowing down. And most studies have shown that when that debt to GDP gets north of 130% is when you can start having problems, with interest rates going higher, some kind of debt crisis, et cetera, which is another reason I'm bullish on gold, because I think the way they'll fight that, and I talk about this, is more QE monetizing debt, which is, of course, ultimately inflationary, which means gold and silver will still go up. And I think even with, we're seeing inflation right now sitting around 3%. That's what maybe the gold market is anticipating problems with the debt problems, and also the debt bubbles. Not just public debt; it's private debt, it's mortgage debt, consumer debt's near all-time highs, credit card debt, all of that sort of thing. And one thing I talk about in the book too is, again, the interest, what's happening now, because interest rates, and it's like, governments are pretty stupid, right? And they're kind of the last ones to know. So like you go look at right now, the way the government is borrowing right now, they're still borrowing like it's 2020 and interest rates are 0%. Well, of course, even though the Fed's going to cut a couple more times, the 10-year bond's about 4%. Short-term rates probably aren't going to go much below 3%. So rates are now much higher and debt levels, of course, much higher. So this continues to eat into the budget. We are seeing $1 trillion a year now in interest payments on the debt. Now, at roughly a 40 trillion debt, that's an average rate of 2.5%. But let's say rates average out around 4%, right? Well, say the debt goes to 50 trillion. Well, 4% of 50 trillion is 2 trillion a year. Like 2 trillion a year, that would basically increase the deficit by another trillion. And then it becomes like a snowball where like that debt goes up, the rates keep going higher. And then the government can't fund services like Social Security and Medicaid and Medicare and stuff like that. So I talk about like that debt cycle is coming to the end just because the debts are now too egregious. They're too high.
Right. Well, it's just, but it's not coming in today, but this is the big, underlying trend impacting so much. Like you mentioned, gold and silver, but it's also helping things go up in price right now too.
Well, yeah, and here's the thing right now, because like deficits in the short term are stimulative, right? Like the government spending factors into GDP calculations. So when they do have these big deficits and they are spending 7 trillion a year and they are borrowing 2 trillion a year, in the short term, it can actually prop up the economy. That's what Japan has done for the last 35 years since their bubble popped in 1990, was that Japan has continued to deficit spend to try to prop up their economy because their economy is no longer growing like it was in the 70s and 80s. And but again, longer term, as it eats more and more the budget, and at some point it slows things, and then there's the end game where you have a debt crisis like what happened in Greece in 2012, or what's happened in places like Argentina in the last few decades, where the deficit is so high, you have to basically print money to monetize the debt, and then you get massive inflation. And what happens, it becomes a bit of a Ponzi scheme in the end, because the government is the one who owns its own debt. So actually it's paying itself the interest back in the treasury. It's the only way it's paying it, being solvent. But by trying to remain solvent in that manner, the price of the currency collapses. So one thing that I talk about in the book, and we talk about gold and silver, and Ray Dalio talks about this, is when you're seeing gold and silver go up, it's not so much they're going up. It's, I think currencies are also going down. Like they're gold and silver are currencies into themselves. So they're being basically devalued, or sorry, revalued, and fiat currencies are being devalued against gold and silver. So that's one thing that people have to take in mind. So then this kind of trickles over to what you call the next big short. So we've talked about this, and I've been in and out of this trade for off and on for years, and it's worked a few times very well for me. So in about 2017, 2018, I started to look at the bond market, and what I noticed was the yields on corporate grade investment debt were extraordinarily low. Usually investment grade corporates will yield 6% historically, and they were like 2 or 3% because interest rates were zero, all in the 2010s and early 2020s. And then these companies all went on a borrowing spree because they could borrow money so cheap. So I worked it out, and I saw other studies by people like Jeff Dunlock, and I quote him in the book on this, is that if corporate interest rates on investment grade bonds, so this is not junk bonds, it's just investment grade. This is, the higher, like the companies like Microsoft or Apple and this sort of thing. If those bonds went to normalized interest rates, like 3/4 of those investment grade corporate bonds would be junk. So if you look at something like the LQD, this is the short traders buying puts on it. And this worked well for me in 2018 when rates went up. It worked well for me in 2020. See, and I'll tell you nothing about these LQD trade, that there was very little implied volatility in the options on the LQD. Why? Investment grade corporate bonds are usually very stable and don't trade, they trade 5 to 10% range a year. But if all of a sudden you got a collapse in it, the volatility and the premiums would blow out, and just a small move down, and I mean small move down 15, 20%. Like if you buy puts on a stock like Netflix or Amazon or stocks like that, a 20% move over 6 months is probably going to make you very little in the puts. Like you might double your money. But something like that in investment grade corporate bonds is a way that those things could go up 50 to 100 times, depending on how far out of the money you are, what month and expiry date you have. And you can just do this every year and not even care about, like, you don't have to be the big short guys. You don't have to be a hero. You don't have to make millions off this. But this is an excellent way, I think, for someone to hedge their portfolio. You can stay long crypto or AI or all the risk assets you want to, and you just put a tiny bit of your money in these puts on the LQD. And when those yields blow out and normalize, and most of these companies, the market realizes, just like they realized mortgage-backed securities were junk, they'll realize, oh, these investment-grade bonds are junk, and then you'll see them have to be repriced. And also, the investment-grade market, and Mike can confirm this, actually, all the corporate bond market is not liquid. It's not like you go to the stock market, you own 1,000 shares of Microsoft, you can sell it like that, right? Like that, they don't trade really secondary. People buy those bonds for yield, right? So if all of a sudden these ETFs that own them, like the LQD, has to sell and it gets repriced, there's going to be really no buyers there because there's not a lot of liquidity in that market. And also, here's the last thing. If you go look at 2008, 2000, 2020, times when liquidity dried up, you went into recessions, bubbles burst, the LQD actually separates trade from the TLT, meaning that government rates can actually go down because people do the flight to safety of a government bond. But because liquidity is drying up and companies are more affected by the economic downturn, the LQD can crash too. Like in 2020, we all know the interest rates went to zero when they cut them to zero during COVID, from about 2.5%. But the LQD, for example, completely tanked for those few weeks during COVID in 2020. And same in 2008, when they cut rates to zero that fall, the LQD collapsed. And like I said, because those options and our premiums are low and they are not priced for volatility, like you can just have a 5 or 10% decline and make 10 times on your money. And it's a great way, in my opinion. So you don't have to buy, I do some of this buying bear ETFs and all that sort of thing. I do that sort of thing. But it's like, to me, this is something like you could put 0.5% or 1% of your portfolio in something like this every year. I'm not a financial advisor, so that's not financial advice. But what I'm saying is you could still remain long everything else. And then if the LQD blew up, which I think it would in a market decline, that would protect, you might still end up losing money, but it would protect a lot of those losses.
And everything you just talked about, you go into a lot more detail in the very first chapter of the book, but there's 7 more chapters, each with a whole lot of different ideas in that. And but instead of asking you about more ideas, because again, people more specific days, people should get the book for that. I just want to ask you something more big picture here. Just the title, Mega Returns, and then the subtitle, Profit from Maximum Pessimism. What's the strategy or idea behind profit from maximum pessimism? Because honestly, the guru world, it's the opposite. They just are hype. YouTube's flooded with the crypto gurus. They're not.
Or buy Nvidia, right?
Yeah.
And the thing about doing momentum trading, as you know, because we both have done that too, it works till it doesn't. The nice thing about buying maximum pessimism, now you may have to be more patient. It may not happen overnight. Like anyone who bought gold, for example, or gold stocks when they completely tanked in 2015, they didn't really take off to this year. You had to wait 10 years. But I'm just going to go quickly. I don't have to show it on the screen, but it's going to go look at the HUI. Just going to give you an example of how this works. So what you want to do is buy assets when they're out of favor, right? And you want to buy them when they're cheap. And there's a study I show there by May Faber, not Mark Faber, May Faber, who runs some funds. And it shows what happens to all these asset classes when they go down 60, 70, 80, 90% in price. And the study shows over the next 3 years, on average, they go up hundreds of percent. Right. And you got to look at it this way. Is it going to be easier for a beaten up stock, say that's gone from 100 to 1 to go back to 3 or 4, or for Nvidia to triple from here? It's probably going to be easier for that beaten up stock. So like I'm talking about the HUI. Yeah. And it went from 650 to 100, that low in 2015. And it now stands at almost 600 again. So you would have made 6 times on your money buying the HUI in 2015, right? And I'm just putting up the spiders right now. The spiders in 2015 were trading at about 180, and they're up about 3.5 times. So you made way more, almost double the money trading the HUI, buying it when it was beaten up, right? In 2015 over buying, the spiders. So that's something like a way to do it. And like, for example, I've done it in individual stocks, and I'll give you these individual examples. Like, first of all, I'll give you a historical sample. John Templeton in the 1930s, during the end of the Great Depression, in the late 1930s, saw that the war was picking up steam in Europe, and he knew that the U.S. would be supplying the Allies. So what did that mean? Factories that had shut down, railroads that were dead because nothing was being shipped during the Depression. Those industries would all be revived. They'd be making tanks and airplanes and all kinds of things for the Allies. So he bought 100 companies that were under $1. Most of them were railroads. And on average, these companies went up tenfold in the next, 7, 8 years into the end of the war. And if you go look at the stock market during that time, it did not go up tenfold. I think it went up like 50% or something. And a couple of the companies were actually in bankruptcy and went up 50 or 60 times on their money. So I've also done this myself recently. This was a great year for it. Now, some of it is like the way the structure of the market is now. It's difficult to know why. Like, for example, one of the stocks we did this with was GoPro. And the reason I did it with GoPro was trading at under $1. It was trading at 1/5 of sales. The debt load is not egregious on GoPro. I figured they could survive. They just had to basically find a way to stop their cash burn. So I bought it at 80 cents. It ended up going to $2. I sold it there because I saw it became a meme stock. And it's still, the reason, why did it go from 80 cents to $2? GoPro went from 100 to 80 cents. It was a cheap stock. I did this with, at $1.40, we bought Fubo, the streaming service. This went up to $5 where I sold it. They did a deal with Disney. And then recently, I've done it with like some other companies as well. Oh, I did it with American Eagle, AEO, and they're doing this campaign with Cindy Sweeney and Travis Kelce, and the stock went from about $12, $13 to about 18 in just a few weeks. And the reason I did that is because I saw this catalyst with them doing those marketing campaigns, and also the stock was trading way south of its price to sales. And we both used to read a guy named Ken Fisher, and Ken Fisher was always big on price to sales ratio. So one thing I try to do is also find stocks that are trading less than one-time sales. But also part of the maximum pessimist trade, like Templeton with the railroads, you need a catalyst, right? The perfect example, let's look at uranium stocks, right? And I'm not recommending them. I'm definitely not recommending them at these kind of high levels, but they all collapsed after the uranium bubble of like 2006, 2007. And they were maximum pessimism trades in the 2000 teens, 2020. And they've gone higher. And what is one of the catalysts? Well, actually, because now you need all this more energy production for data storage for AI. People are talking about, they're putting 3 Mile Island back into production. They're talking about putting, nuclear power plants back into production. So they got that catalyst. So because something can fall and remain cheap, but it needs that catalyst for the turnaround, right? So that's another important point about maximum pessimism. You want to buy when the pessimism is high, but you also want to find that catalyst. Like one sector right now, and I talk about in the book, is maybe the marijuana stocks, because they all were nuts when Canada legalized marijuana, then they all collapsed. But now the US is talking about decriminalization and probably legalization, something in the next few years. And of course, the US market is much bigger than the Canadian market, 10 times as big for these companies. So that could be another turnaround play we could see in the next few years.
For sure. Well, if people, want to get more information from you, again, I recommend they buy the book. But if they want more, your updates you put out.
The book has actionable trades, right? And it's like the LQD trade. If you're interested in that, it talks about the structure of it. And then if you go to profitfrompessimism.com, I kind of have 3 tiers of memberships. $5 a month is my basic, where I maybe do like 1 video a week. And then I have a trading blog and all kinds of more, and do option trades and stuff that's a little more sophisticated for my higher price monthly subs, which is $27 a month. And then I have a lifetime subscription where I'm going to add even more things. I'm actually going to add, right now I have a trading blog where I have these 2 small portfolios that we trade, but I'm actually going to add a portfolio that is like a dividend income portfolio. And also because I talk about shorting and because the market is expensive, and I did this in 2015 when I thought the market was going to correct, I'm going to add a short selling portfolio as well. So, and that will all be for like, I think the short selling portfolio I'm only going to make available to lifetime subs, because short selling is very sophisticated, and I really don't want people who aren't sophisticated, maybe, experienced investors short selling. So, but yeah, anyhow, that's kind of what I do. And, a lot of the stuff we talk about in the book, I will talk about in more detail in, my newsletter. And my newsletter doesn't take a long time to get through. It's mostly videos and media now, because that's the way the internet has gone, rather than the written word. So you can I do a few of these videos a week. They're usually 10 to 20 minutes. And also Profit from Pessimism, my YouTube page, which I hope you'll put the link under this video and will be linked on my page. If you sign up for that, I usually do a couple free videos a week that are about 5 minutes in length. And we do fun videos too. I talk about living in the Bahamas. I talk about hurricane season. I go to the beach. I shoot videos from the beach. So it's not just all boring financial investing as well.
Great. Well,
yeah, I show people, look, I show people my cat.
Oh,
she's getting old. She's 14 years old now, but
getting fat too.
Yeah, she's fat and old. So
Well, thanks for taking the time to talk to me and everyone else, and definitely recommend they check out that information. I'll put a link to the YouTube channel below this video.
Yeah, thanks for having me.
Sure.
And like I said, we have fun. Like, it's Friday afternoon here. I'm sipping on a margarita.
That's right. That's right.
Okay, man.